Hello, and welcome to Learning Outcome 2. How do financial statements guide business decisions? This video explores the structure and interpretation of financial statements. Discover how these tools aid in strategic decision-making. Auditors play a crucial role in ensuring the accuracy of financial information. They verify the financial statements of a company. This helps maintain trust among stakeholders. Auditors differentiate between published and internal financial data. Their work supports informed decision-making. Financial statements include the statement of financial position. They also cover financial performance and cash flows. These documents provide a comprehensive view of a company's health. Understanding these statements is key for decision-making. They reveal the financial status and potential risks. The accrual and cash flow approaches are fundamental to accounting. Accrual accounting records revenues and expenses when they occur. Cash flow accounting records when cash is exchanged. Each method impacts financial reporting differently. Businesses must choose based on their decision-making needs. Final accounts provide a snapshot of a company's financial health. They include the balance sheet and income statement. These accounts are essential for strategic planning. Proper evaluation helps in understanding financial trends. Decision-makers rely on this information for future strategies. Interpreting financial data requires understanding balance sheets. Income statements and cash flow statements are equally important. These documents reveal a business's operational effectiveness. They help in identifying strengths and weaknesses. Accurate interpretation guides strategic business decisions. Different stakeholders use financial statements for various purposes. Shareholders seek information on returns and stability. Suppliers and lenders focus on security and liquidity. Management evaluates trends and profit levels. Understanding user needs is crucial for financial reporting. Ratios simplify complex financial data. They highlight relationships between financial variables. Profitability, liquidity, and efficiency ratios are commonly used. Ratios aid in benchmarking against industry standards. However, they have limitations and should be used cautiously. Profitability ratios assess a company's ability to generate profit. They include gross profit and operating profit ratios. These ratios indicate financial success and operational efficiency. A higher profitability ratio suggests better financial health. They are crucial for investor and management decisions. Liquidity ratios measure a company's ability to meet short-term obligations. The acid test ratio is a key indicator. It assesses the company's financial stability. A higher ratio indicates better liquidity and lower risk. These ratios are vital for lenders and investors. Efficiency ratios evaluate how well a company uses its resources. They reflect the management's effectiveness in controlling costs. These ratios include inventory turnover and asset turnover. Higher efficiency ratios indicate better resource management. They are critical for operational assessments. Capital ratios measure a company's financial leverage. They include the gearing and interest cover ratios. Investor ratios focus on earnings per share and dividend yield. These ratios help in assessing investment risks and returns. They are essential for strategic financial planning. Ratio analysis has its limitations. It relies on historical data, which may not reflect current conditions. Ratios can be affected by accounting policies. They provide a narrow view without context. Users should combine ratios with other analysis methods. Horizontal analysis compares financial data over time. It identifies trends and growth patterns. This method contrasts with vertical analysis. It focuses on changes in financial statements. Horizontal analysis aids in forecasting and strategic planning. Industry benchmarking compares a company's performance with peers. It uses average ratios from similar companies. This method provides an independent performance yardstick. It helps identify strengths and weaknesses. Benchmarking is crucial for competitive analysis. Financial analysis supports strategic decision-making. It involves evaluating investment opportunities and risks. Decisions affect the company's financial ratios. For instance, taking a loan can improve liquidity. Strategic decisions must consider long-term impacts. Managers use financial analysis to guide strategic portfolios. They assess profitability, liquidity, and efficiency. Recommendations focus on improving financial health. Managers must consider industry trends and forecasts. Effective strategies drive business growth. Comparing Papaka and Anika reveals distinct financial profiles. Papaka shows better profitability ratios. Anika excels in liquidity and risk management. Investors must weigh profitability against risk. The case study illustrates strategic investment decision-making. Financial decisions have broad impacts. They influence company performance and market perception. Decisions affect financial ratios and stakeholder confidence. Companies must align decisions with strategic goals. Long-term success depends on informed financial choices. Financial analysis must align with business strategy. Ratios may highlight weaknesses needing attention. Strategic plans should address these issues. Changes take time and may worsen before improving. Financial analysis should consider both past and future. Financial statements provide structured and detailed information that supports effective business decision-making. The income statement shows profitability over a specific period, helping managers assess revenue generation and cost control. The balance sheet outlines assets, liabilities, and equity, allowing businesses to evaluate financial stability and long-term sustainability. The cash flow statement highlights how cash is generated and used, ensuring the organization can meet its short-term obligations. Together, the clear structure of these financial statements enables managers and stakeholders to analyze performance, identify risks, and make informed strategic decisions. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 074-843-61688.